In today's video, we would like to discuss how the expectation of lower interest rates are impacting financial markets. The big events from this week will be the US Federal Reserve's interest rate meeting, as well as the Bank of England's interest rate meeting. And just to provide some context as to where we are, we're seeing that developed market central banks are looking to cut interest rates, given that inflation is on a more sustainable at target rate of roughly 2%. Last week, we had the European Central Bank provide their second interest rate cut of 0.25%, taking rates in Europe down to 3.5%. And if we think about this week, what markets are expecting, starting with the Bank of England, markets aren't really expecting much of a change, only about a 25% probability of an interest rate cut. However, if we think about the US, we know that Chairman Jay Powell provided the market the idea that they're going to look to cut rates in September following their Jackson Hole meeting. So really the debate for financial markets has been whether we'll see a 0.25% cut or a 0.5% cut. And since then, we've had data that would support either. We've had higher inflation, which would support the 0.25%, and also slowing employment data, which would support the 0.5%. And markets at the minute are favouring that 0.5% cut. About a 72% probability has been assigned to that outcome. Now, we know that interest rates have a big influence on financial markets, but we really want to provide some context into what that has meant. So if we start with US 10-year Treasury yields, they have fallen all the way to 3.6% as markets have baked in higher expectations of lower rates in the US. Now, that is the lowest that US 10-year Treasury yields have been in the last 16 months and is even lower than what we saw in January of this year, where markets got quite optimistic around the prospect of lower interest rates in the US. But it's not only fixed income where lower interest rates have an influence. We're also starting to see that influence come through within equity markets. As we know this year, AI has been a big theme for equity markets, particularly within the US. So if we look at sector performance, we can see those areas that are linked to AI and AI infrastructure being the best performers this year. So things like IT, communications, and consumer discretionary have been the best performers, just riding off that AI optimism. But what we also know is that because of that optimism, investors have placed higher valuations on these stocks, expecting them to deliver superior earnings growth. And as we've seen the prospect of interest rate cuts come through, we're now starting to see markets rotate. We're seeing investors sell down positions in those more expensive areas of the market and rotate into those areas that have been more unloved this year. So things like real estate, which really do benefit from lower interest rates, are starting to be the better performers so far over a shorter term period, over a month, say. So thank you for watching today's video. We'll continue to provide updates on central bank action throughout the week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.